Hey, this is Matt Bontrager, and I'm the managing partner of TrueBooks, a CPA firm that helps small business owners and real estate investors bring down their tax bill through tax strategy, not just tax preparation. In today's video, I want to talk to you about what the difference is between a standard deduction and an itemized deduction when it comes to your taxes. Now, when it comes to your taxes, I will say if you are just a W-2 employee, there is not a lot you can do for your tax bill as far as lowering it through strategies. That's because if you just earn your money from being a W-2 employee, you don't have a lot of flexibility when it comes to tax strategy. If you're a business owner or you're self-employed, you have a whole new world of tax code available to you to bring down your tax bill. But when it comes to itemizing your deductions or taking the standard deduction, this is available to anybody that files a tax return. In order to help nail down how these tax strategies work, I'll have a couple examples that we'll go through in the video as well. Because one of the biggest misconceptions is tax deductions are a dollar for dollar reduction on your tax bill, when in reality, a deduction just lowers the amount of income that is subject to tax. So let's jump into a quick example. Let's say you have taxable income of $100. Then you're at a 15% tax rate. Well, that would mean that you're gonna owe $15 in tax. But let's say that you get an itemized deduction or a standard deduction. And let's say the itemized deduction is $10. Well, that means that this $10 would then lower this $100 to $90, and you would now only owe $13.50 in tax. So you'll notice that it didn't actually lower your overall tax bill. It just lowered the amount that is subject to tax, and that is how deductions work. Now, the first thing I want to go over is the standard deduction, and that's because I like to call this the freebie by the IRS that you get in the event that you can't itemize your deductions. Now, when it comes to the standard deduction, this will depend on what type of filing status you have. I made a video on filing statuses if you need help identifying which filing status you need, and a link to that will be in the description below. Now, for what the standard deduction is based on filing status, if you are single, your standard deduction is going to be $14,600. If you're married filing separately, it is also going to be $14,600. If you're married filing joint or a qualified widow, your standard deduction will be $29,200, which you notice is just simply double what the single rate was. And then if you're head of household, it's a little bit in the middle at $21,900. So you'll see that depending on what your filing status is, you get either a larger or smaller freebie by the government, which makes sense. If you're filing single, you get X. If you're filing married, there's now two of you, so that standard deduction is doubled. This amount for the standard deduction typically increases each year with inflation. So last year for 2023, it was $13,850 for single. Now, as you see, it's $14,600. So again, these numbers will change typically each year with inflation. And that's pretty much it for the standard deduction. And that's because this is very simple. This is, again, the freebie that is given to you by the IRS in the event that you can't itemize your deductions. The main difference between itemizing deductions and the standard deduction is you're always given the standard, but in the event you can itemize and those numbers are higher than your standard deduction, you can take your itemized deduction. Let's jump into itemizing your deductions and what those entail. Now, the way itemized deductions work is there's different categories for different deductions. And if you total all of those categories up together and that number is greater than your standard deduction, you will take the itemized deductions. The first itemized deduction category that I want to go over are your medical and dental expenses. This consists of out-of-pocket medical and dental bills such as prescriptions, premiums, and things like that for you, your spouse, or any dependents within the household. Now, there's one little caveat here for medical and dental expenses, is that you only get the amount that is above 7.5% of your AGI. Let me show you a quick example of how that works. Let's say that your AGI, your adjusted gross income, is $10,000. Well, 7.5% of that is $750. If our medical and dental expenses are $1,000, well, we only get the difference, or what's above this 7.5%. So in this case, the amount that is above the 7.5% is the difference between the $750 and the $1,000, which would be the $250 right here. So you'll notice that even though you get to deduct your medical and dental expenses, you're still capped at what is only above the 7.5%. So for example, let's say that your medical and dental expenses were only $600. You would see that you would not get any of that because it's not above the 7.5% floor. So even though there's a floor to medical and dental expenses, it's always good practice that at the end of the year, you keep a tally or a spreadsheet of some sort totaling what the total cost was for your out-of-pocket medical and dental expenses. For remember, not just you, but your spouse and your dependents as well. If you ask me, it's gonna be best to keep a spreadsheet because tracking down all of your prescription receipts, your premium invoices and things like that is going to be a little bit difficult. Not only should you keep those documents in the event that you ever need them, but 100% would recommend keeping a spreadsheet, which I'll also link below in the description that you can use. The next itemized deduction I wanna cover is state and local taxes, which we call SALT. This has a cap to it of $10,000 a year. So even though if you blow past it, you still wanna make sure to get the $10,000 that you're entitled to. Because then if we take the $10,000 of SALT expenses, plus your medical and dental premiums and things like that, we could beat the standard deduction here. So for your state and local taxes, the main three areas that we want to focus on are your property taxes, income, and sales tax within those respective states. Now, how are you supposed to keep track of all of the amount of sales tax that you've paid in a respective area? That'd be a little bit tough. Well, one, the software that we use and what most tax preparers will use will give you an estimated amount of state and local taxes that you've paid if you're using a software that obviously supports that. Now for property taxes, it's easy to go online and pull what that amount was for a specific year on property taxes that you've paid. It's typically included on a mortgage interest statement called a 1098 that you might get from your mortgage company as well. At the end of the day with state and local taxes, you wanna make sure one, you're keeping track of what property taxes you pay, whether that's logging on to the county assessor site or using a 1098 form that your mortgage company will send you each year. On sales tax, it's typically best to use the software to generate what potential sales tax you paid based on the income that you made and things like that. But if you bought any large items, such as a new vehicle or a new off-roading vehicle, anything with a large amount of sales tax, make sure you keep that documentation as well and give it to your accountant because that will also go into this SALT total, state and local taxes. Now there's a difference between sales tax and income tax for that respective state, which is why it's important to keep your documents because you're only gonna wanna deduct the higher amount because you can only deduct one or the other. So when it comes to sales tax versus state tax, make sure that you're keeping documents for all of your larger purchases, which is going to show you what your sales tax was on that item versus the amount of state income tax that you've paid so that your accountant can help you figure which one is better to take. A quick tip here is that you can actually prepay some of this state income tax or sales tax potentially as well, or even property taxes. So in the event that you have some room to hit that $10,000 mark, and you want more of a deduction, make sure that you're talking to your accountant about that because that's a great strategy near the end of the year if you're trying to increase your overall deductions. The next itemized deduction I want to cover is mortgage interest. And this one's pretty straightforward because you can deduct the mortgage interest on either a primary or secondary home. Now there is a cap with mortgage interest, and that means that you can only deduct mortgage interest on a loan of up to $750,000. If you got the loan before December 15th, 2017, that cap amount is actually to take out huge mortgages on these big mansions and deduct the mortgage interest for it on your tax return. So they're trying to keep some sort of cap limit there. And there's no cap to the actual deduction amount that you can take on the mortgage interest. So if you paid $50,000 in mortgage interest on a $700,000 home, that's fine, typically unlikely. But at the end of the day, if you have a mortgage in excess of $750,000, your accountant will have to run some math for you because you're still entitled to take the deduction. You're just going to be limited on the total amount of mortgage interest you can take compared to what you actually paid. Now, figuring this amount out is usually pretty easy because by the end of January the following year, you will receive in the mail a Form 1098 letting you know what the mortgage interest was that you paid to that institution, most likely a bank, as well as what the property address was and all of the other details that the accountant will need. I will say mortgage interest was usually the one that allowed people to beat that standard deduction because usually that amount is much higher than your other itemized deductions, medical and dental expenses, state and local taxes, and things like that. But now that the standard deduction is so high, most people are still going to use the standard deduction. But I can say, me and my wife, it was our mortgage interest in the last couple years before these tax changes that allowed us to itemize our deductions. Now, the next itemized deduction, everyone's favorite, charitable contributions. Charitable contributions are donations that you make to qualified organizations, which is an important note to make here. You can't simply walk down the street and hand somebody $10,000 that looks like they're in need and get a deduction for it. You actually have to give the funds or property, such as items of clothing or old stuff maybe laying around your house that you want to give away. It has to be given to a qualified organization, such as a 501c3. Now, as always, there is a cap of what you can give away and get a deduction for, which is 60% of your AGI. So think of it as if your AGI was $10,000, your adjusted gross income, you'd be limited to only being able to deduct $6,000 of cash that you gave away if you wanted to give away that much money. Most of the time, people are not having problems running into these caps because you usually don't see people giving away that much of their money. So typically, these don't come into play, but just so you know, if you were trying to be extra generous and give away more than 60% of your adjusted gross income with cash, you would run into a deduction problem there. A quick tip here is that you can actually give away appreciated property and it can work to your advantage really well. So let's say that you bought a piece of stock at $100 and it is now worth $200 and you wanted to give it away. You're actually going to get a $200 deduction for giving away that piece of stock when in reality, it only cost you $100. So my tip here is for any amount of charitable contribution deduction that you want to take on your tax return, make sure that you're keeping really good documentation for it. If you're giving away a treadmill that you bought 5 years ago, make sure that you know the cost of what that treadmill was so that in the event you're flagged, you can justify what it was. If you're giving away cash to maybe a church or a nonprofit of some sort, make sure that you're getting some sort of invoice detailing the amount that you gave to them so that you're in agreement with the organization in the event that you're flagged for audit. Any position that you're trying to take on a tax return, you need to make sure to keep the proper documentation on the back end in the event any questions come up. Next is going to be casualty and theft losses, which are basically losses that are not covered by insurance in the event that something happens. And now remember, this is not covered by insurance or reimbursed. So in the event that something happens and you lose maybe $10,000 in cash, but were reimbursed for that amount somehow, you would not be able to take that as a deduction because in the end, you didn't really lose out on $10,000. You did, but then you were reimbursed for it on the back end. So again, this has to be for property losses that were not reimbursed or paid out via insurance. Similar to medical and dental expenses, this has a floor of 10%. So back to that example of you can only take the amount of deduction in excess of 7.5% for medical and dental. This is in excess of 10% as far as your casualty and property losses. There's another small caveat here where you have to deduct $100 per casualty or theft loss, which usually amounts to be pretty minimal. But the hardest part here is meeting that 10% floor because remember, you have to lose in excess of that 10% to really only be eligible to take the difference. So at the end of the day, something that's available to you, but we usually don't see it in practice that much. And the last one that I want to cover are miscellaneous deductions. There's a few different categories that get roped into miscellaneous deductions, but this also, similar to medical and dental, casualty and theft, has a floor, but only of 2%. There's three main categories here, which are unreimbursed employee expenses, tax preparation fees, and investment fees. Unreimbursed employee expenses can be things such as supplies or uniforms that you have to spend money on at your own job in order to hold that position. Tax preparation fees are pretty simple. That is simply what you're going to pay a tax preparer to help prepare your tax returns. And investment fees typically consist of fees that you will pay to like a financial advisor for helping managing your portfolio. But remember, if your fees total $4,000 at the end of the year, it doesn't mean that you get the entire $4,000 because you are subject to that 2% floor. So let's say that you made $100,000, your 2% floor is $2,000, and you had $4,000 of these unreimbursed fees, tax preparation fees, investment fees, you would only get to take the difference of that $4,000 and $2,000 for a total of $2,000. Also, not to mention, safe deposit box fees or rental expenses for safe deposit boxes can also be included in these miscellaneous deductions. But you'll see there that all of these miscellaneous deductions need to be added up, and then in the event that they're larger than that 2% floor, then you will get to add those as part of the entire bucket for your itemized deductions. Now, when it comes down to the difference between the two, there's not necessarily one that's better or worse. It's all going to depend on which one you can get the most bang for your buck out of. You'll see that it's going to take a lot more document retention to go the itemized deduction route. But at the end of the day, if your itemized deductions are in excess and greater than your standard deduction, you're going to want to take your itemized deduction, which is why it's important to make sure that you have that conversation with your accountant, like, hey, I do have medical and dental expenses. I do have property taxes and mortgage interest. Because what we can do is we can run the math and see which one is higher to make sure that you get the better deduction at the end of the day. As far as strategies for maximizing your deductions, some of these are just going to shake out for what they are, because I'm not a fan of necessarily spending money for the tax deduction. So my tip here is to make sure that you're documenting what you're already spending your money on within this itemized deduction category. So your mortgage interest, that's going to be accounted for. You're not looking to pay more than you have to. So make sure that you just collect the document that says what the amount is. Same thing with medical and dental. You're not out walking around trying to pay a dentist more money to get a larger tax deduction. So if you ask me, make sure that you're keeping track on a spreadsheet of what each one of your dental visits costs or what each one of your prescription cost, because then at the end of the day, you can add that total and see if you're able to take it and add it into your itemized deductions. The only actual tip that I have for you there is some of this you can prepay. So let's say that you're on the verge of year end and you want to increase your tax deductions. Maybe you should prepay some of your property taxes, things like that. Or you want to increase your charitable contributions. It's December, you have more disposable income than you thought. Maybe you can make more charitable contributions near the end of the year. That will help bump your deductions and save you more on tax. And I can tell you now, the biggest pitfall that you would run into is in the event that you're flagged for audit, you're going to need documentation to back up every one of those numbers. So whether it's a prescription cost or a dental visit or a charitable contribution that you made to an organization, make sure that you have the document that backs up and ties to the amount of money that you gave them. At the end of the day, tax is truly a game. And so I think that while these two are different strategies that you can apply to your own situation, is first, I'm never a fan of spending money just to save on your tax bill. But you can see, as you're navigating your way through the year, there's different moves you can make to increase your overall deductions, which will save you on your tax bill. So my recommendation here is make sure that you're keeping the proper documents and also asking questions to who it is that prepares your tax return to make sure that these moves that you're going to make are actually going to save you money on your taxes, and two, fit within your overall strategy of how you're trying to manage your finances. If you're really trying to grow your worth, it's not going to make sense to go out and prepay all of these expenses and donate half of your money away. So my tip there is make sure that you have an advisor or someone that you can ask questions to along the way to make sure that what you're actually doing aligns with the overall picture. Well, hey, thanks for watching this video, and as always, like and subscribe to the channel. And if you have any other topics that you want me to drop some tax knowledge on or share my experiences with, feel free to put them in the comments too. Cheers.